All right, hey everybody. You ready to get started? So I think we're gonna need some New York City love after we just got that Miami beat down that Mayor Suarez tried to provide. We got to bring it back to New York now. We all know that South Florida comes back to earth eventually, right? It can't last forever down there. I think that's clear. So this next panel is about office space, but it really is about the future of New York City. You know, during COVID, as we all know, office buildings were empty, and they're still empty enough to a degree that it means a transformation of the city is ahead. Maybe not a wholesale transformation. Maybe we're not going to have an urban doom loop, and one of our panelists up here invented the term, so we're going to ask them in a second. But there's some fundamental questions to answer. How much space does it make sense to convert? How much distress is there going to be? If you're owner of a Class B or C office building, do you just hold on for dear life? We've even got people building Class A office space, which seems crazy. Two of the guys up here today. So I want to welcome them and introduce them real quick, and we'll get to it. So Philippe Visser from Related. He led the development of Hudson Yards. You guys might have heard of it. Biggest private development in U.S. history. And there's still another office tower to go at Hudson Yards, and a casino project with office space, $12 billion. So welcome, Philippe. We've got Will Silverman, Eastdil. So office buildings have been slow the last couple years. Not for Will. He just did some whoppers, including two $900 million deals in the past several months. Prada and Gucci were the buyers. So we're going to hear if it's going to be a busy year ahead for building sales. But Will's a guy to talk to about that. We got Jed Walentas, the chair of REBNY, new chair of REBNY, most powerful trade group in New York for real estate. And yeah, so he was just in the thick of dealing with the whole housing budget and all that stuff, fun stuff in Albany. And he's got the new Domino Sugar Factory site, which is offices. And we're going to hear more about that. And finally, Stijn Van Nieuwerburgh, professor of finance and real estate at Columbia. The New York Times dubbed him, sorry Sven, the prophet of urban doom when he put out a paper 2 years ago. You know, rightfully at the time, you know, was there going to be an exodus of office workers? Tax revenue was going to go down, and you know, that would force service cuts that would then imperil the city. So my first question is, then, are we post-urban doom loop at this point? What is the prognosis of the city from your point of view?
Well, thanks for the question. Thanks for having me. You know, in my mind, we're not at the bottom in the office market. We still have about half of all leases that have not come up for renewal yet. We have a lot of distress that has not really begun in earnest yet. So, you know, it's too early to call the bottom in my mind. Now, you know, just to be clear, the urban doom loop has always been a warning. It has not been a prediction. New York City has a lot going for it. It's a very well-diversified economy. Young people want to be here. None of these things have changed. People have come back. Apartment rents are as strong as they have ever been. Innovation is going strong. I am not bearish on New York City. I am just saying we're going to have to do something else with a chunk of our office.
Yeah. And Will, I know you have a theory about some of this. You know, it's the best of the rest theory. You want to explain what that is?
Sure. I think in general, you know, we've been saying for a while, there's no history book called Pendulums that swung just right, right? And people took this view on office at the very beginning that if it's not, you know, Hudson Yards or One Vanderbilt, it's going to be toast. And then slowly but surely they widen the aperture. I think now there's a general view that the obsolete inventory is probably toast, and we'll deal with that. But that very good office buildings, right, in a 400 million foot market, that probably means more than 100 million feet, are going to do just fine and probably outperform. And the market's starting to express a more nuanced view that's accepting of those things. So we're selling buildings in, you know, places like Financial District and Third Avenue that had been the sort of whipping boys of the market, but people are saying, well, no, I can articulate a thesis that I like a particular building in that submarket without having to say that I like the entire market.
Yeah.
So we're getting a little bit stronger in that regard.
If people could quiet down a little bit. Thank you. So you're saying that's kind of a new situation in the last 60 to 90 days. You know, before that, people would have just said Third Avenue, forget about it.
Right. but I think they're starting to see the performance. I mean, anyone who has tried to walk around Midtown midweek, you end up with bruised shoulders because there are so many people packed in, right? It doesn't square with the headlines that people read. And so I think people have started to observe those realities, and they're starting to see that buildings in brand new space obviously is doing well. Buildings in concentric circles around Grand Central are doing well.
Yeah.
Buildings at prime locations in Midtown South are doing well. You'll notice that I left downtown off the list.
Yeah.
Right, but a lot of those things are outperforming, and it's starting to be reflected in the investor thesis.
So which is the areas that concern you most? I think you mentioned something about Chambers Street and below.
Just to be clear, nothing that I said is going to save you if you own a mid-block building in the West 30s that has terrible light and 10 other like-kind buildings,
Right.
On the same block.
Right. So the question about, office routines and how that impacts values. I mean, how much do you think we're like in a stable position now as far as this is the back to work setup? People, certain portion of companies are going to do 3 days a week, certain portion 5 days a week, small portion completely remote. Like, has the office work pattern stabilized, or do you think it's going to still change dramatically? Any of you guys?
I mean, what I would say is there's a continuum, obviously, as you laid out, and we see it evolving. And look, we related in Hudson Yards and the kind of product we do, we play obviously at the very high end of the spectrum, class AA, lifestyle office, there's lots of words for it, but the whole idea for us is to use the office as a tool to get people back, right? Which we're seeing really increasingly heads of HR, right, on the tour as part of the decision making. And that's because they want their talent, their top talent, which drives their companies to be happy, and they want them to be together. You look at this room, right, and all these people rubbing shoulders, they're here for a reason, right? They're not zooming in, and companies feel that. I think it's really almost an obvious point at this time. So I think what we're seeing from our tenant base, which is financial and legal and tech, is just as kind of what you would expect. Financial's back, many of them 5 days a week. And legal is really trying to push back. So I think, and then tech has been slower, but is now just articulating really where we're at. So I think this is still a continuum, and we are now where we thought we would be 2 years ago. And where, look, who knows about 5 days a week? I won't make that kind of pronouncement, but I think that you're going to get a much more push from across the board from people being in the office.
Yeah. It's interesting that it's been bucketed industry by industry. It seems like each industry has its pattern at this point. Jed, what are you seeing? Are you seeing changing usage patterns?
Yeah, I mean, I really agree with Philippe. I was always a believer that people need to be in the office to be productive. There are obviously certain sectors, certain businesses where that's not true, but from my take in the world, people running real businesses need people at work. It doesn't need to be 5 days a week per se. You don't need to have ankle bracelets on them and track them everywhere they go, but people need to be in the office doing things with real people, looking people in the eyes, communicating in that way. I do think the press narrative, I think a lot of what's happened in the office world in New York is there was just tremendous bloat, right? I think companies had way too much space. I think decisions were being made by middle managers and not controllers of capital in a wildly optimistic framework where people were gobbling up space that they thought they might need in 4 years, but they were taking it today. And the people who own the companies were too fat and rich and asleep or doing God knows what. And they were like, sure. I think a lot of the contraction in the office market has come from that, not from the realities of Jim or Sally is at work 4 days a week or 3 days a week as opposed to 5 days a week. And I think the press narrative on that has been completely wrong. And I think it'll take time at some juncture. Capital will become a little available, and a lot of businesses that had tons and tons of fat and the values didn't match what they were actually creating in any real way at all. It'll take a couple of years for that shit to all go away and real productive businesses to reestablish themselves and then to start to grow again. But to absorb 100 million square feet is going to take a minute or two.
Yeah.
Well, I think
both Jed and Philippe used a very important word, which is productive and productivity. And I think the distinction people keep on drawing is sort of a false one because people use this term commodity versus non-commodity. What they really mean is this space that you could persuade a tenant can be used to leverage the productivity of their people, or is it merely a cost center? Because one of the problems we have as an industry is the good that we're providing is extremely easy to quantify the cost of. How much am I getting for my space? How much is it costing me? I'm a CFO, I know. But if you say to a CEO, how much more productivity are you getting out of your people by being in Hudson Yards versus in a windowless basement in Newark? They can't tell you, right? So I think what we need to do a better job of is articulating things. One of my favorite stats on this is people who sit within 15 feet of a window get about an hour more of sleep per night than people who sit further away. And the research on sleep is pretty well established at this point. So instead of saying to the CEO, do you want the space with the better light and air? Do you say, hey, this floor costs $3 million. The compensation package of everybody on it is $30 million. If I could get you an extra 10% of productivity out of your $30 million investment for only a few $100,000 more, where else are you going to get a return like that? Right? So I think the conversation shifting towards productivity is probably the way we eventually win the battle on moving pricing back to where it was and further.
And to that point, that's why financials back the most, because it's the people who actually earn bonuses, right? Like they are hustling every single day, right, to make money, and they want any little edge, right, that they can get. And being in the office is obviously a huge edge to that. And by the way, that's what New York was literally founded on for hundreds of years, right? So, so I think greed will get people back into the office more.
Yeah, yeah. And how does that impact, Philippe, your decisions about the next Hudson Yards office on 35th Street, the office tower? Where's that at? How are you kind of thinking about that?
Yeah, I mean, look, I think most people in the room know there's sort of these two markets, and there's actually quite low vacancy, right, at the very high end of the market. And what we want to do is get another tower going in Hudson Yards. We're full. We're 100%, so we literally don't have space for large users right now. We're talking to anchor tenants, and we'd like nothing more than to be the only game in town in 26 and 27 leasing space. And one other thing to talk about the power of New York, right? And it's not just productivity in the office, but it's actually the power of getting people together like something like this. And we see companies taking more space because they've been quite successful, not just the people based in New York, but across the country, flying them in and having this be a hub, right? So it's not just people at workstations, it's people meeting up. And I think actually, if we look at markets across the country, I think New York has a real edge for that as a big global city and a place where people want to be, right, to take that space as well. And I think that's another reason why you've seen a high demand at at the high end.
And is that 35th Street project, is that dependent on getting an anchor tenant, or is that just you're going to go ahead with it regardless?
No, we're gonna need an anchor tenant for sure.
Yeah. And Jed, how about you had the Domino Sugar Factory site launched in September, about half a million square feet. What is leasing looking like for that now? Obviously, you're not getting finance firms in there, but what is that?
Yeah, so we're too dumb for anchor tenants. We're going to learn from Philippe and Blau. We're the only people dumb enough in the world to build a spec office building through COVID. It's going remarkably well. First of all, I'm super proud of the asset. It's super complicated over there. The building came out great. Anyone that hasn't been, I'd encourage you to come check it out. Unlike Hudson Yards and places in Manhattan, it's not a headquarters location in today's world. Maybe if the market was tighter, you would see somebody make that jump. In this moment in time, I don't see us getting a 300,000 foot headquarters group coming out of Manhattan. What we will get, and we have gotten, we've already done 2 pre-built floors. They're almost all gone. So we're taking full 30,000 foot floors, breaking them up into 4, 5, 6,000 foot suites. We have 2 full floors that are basically already leased since November, December. The building's still finishing. They just put the canopy on it this week. Retail's not open yet. So the building gets better and more livable every day. So we've filled up 2 full floors already like that. We're starting construction on a 3rd. And then the other thing that I really think we're going to get in Brooklyn, and I think it's not only a model for us, but for all of our competitors and kind of compadres over there, I think you're going to see Manhattan headquarter tenants building 25, 30,000 foot Brooklyn satellites. And again, in the conversation that we're having here, you know, companies are all about people, as we've touched on. The question is, how do companies recruit the best people? How do they make them the most productive? How do they retain them? More and more and more human capital is living in Brooklyn. And there's going to be some subset of those people who are like, you know what? I'm not schlepping all the way to 57th Street or schlepping to Hudson Yards every fucking day. Give me an outpost within 10 or 20 blocks of where I live, and create opportunities for me to do things with certain groups of people there. So I think you're going to see bigger Manhattan companies looking at satellites there to do special events, to cater to a certain part of their human capital split. And I think that's kind of what you'll see in the refinery building over the next 2 years, year and a half as we lease it up. There's an Equinox opening there in the fall. There'll be more and more life. The park, the last piece of the park opens in September. So the quality of life there is off the charts. It's definitely a value proposition from a rent standpoint. But I don't think we're at a point in the world where you're going to see 300, 400, 500,000 foot companies move headquarters out of Manhattan. Yeah. As the market tightens and the world continues to change, maybe, but that's going to be our trajectory at the refinery and kind of the playbook that we're running. And I think it all complements each other.
Yeah. And by the way, just to jump in, because it's sort of, call it the right or certain areas of Brooklyn, right? So it's the places, and this, again, you talk about the doom loop, this is the anti-doom loop, right? Which is, it's the places where people have fun and where talent wants to be, right? And you go to the Williamsburg waterfront, and I gotta say, developers don't often compliment each other on that. It is spectacular. If you haven't seen it, you should definitely see it. It's a gift to New York. You know, I know Jed was personally involved, and it's just amazing to walk through it, what they did with the old and the new. And it just gets you excited to be in New York, right? And but you contrast that to like downtown Brooklyn, which I don't want to beat up on downtown Brooklyn because I'm a Brooklynite myself, but there are office buildings that are just literally sitting empty. Yeah. Like the Savannah's building there is 100% empty. So it's pretty fascinating that, you know, Jed is doing those kind of pre-builts and those deals and getting people in, and that's because that's a lifestyle they're getting, and they're not seeing that in even in a beautiful Class A office building in downtown Brooklyn.
Totally. And it seems like, obviously, like you're saying, the days of Vice Media taking 300,000 feet are over, but it's interesting about the satellite offices. So do you see, like, you know, for example, a Meta, you know, doing that 30,000 square foot satellite office? Is that the kind of companies you're thinking about?
Yeah, I mean, we won't. I mean, that would be great. Thank you very much. Sure. Yes, yeah. Please.
I'll check with Mark.
We also know about the beggars and the choosers in life in this environment. So, but yeah, I think the whole spectrum of broad users, whether it's tech or finance or, you know, insurance. I mean, again, we wouldn't be, you know, media. I think there are lots of sectors that would go over there. But I think it's the model where, you know, probably companies with a national footprint or certainly regional. You've got 3, 4, 5, 6, 7, a million feet in Manhattan. You have a CEO and an executive group that commutes to Manhattan. And then those people aren't moving to Brooklyn in those companies in today's world. But, you know, more and more, as I said, you're going to have hundreds and hundreds of employees who are relocating, not just to Williamsburg, but all over those Brooklyn neighborhoods. It'll be convenient to some, not to others. But, and yeah, I think we've built a really special place. And you know, as has Philippe and Jeff and the work they've done at Hudson Yards. I mean, in hindsight, it looks easy. The work they've done to make Hudson Yards what it is from an office standpoint is one of the great miracles of New York real estate over the last 25 years. Philippe and I love each other. We went to school together. We've not loved each other a long time, but I'm telling you.
They were college classmates at Penn.
It's one of the great accomplishments in New York, truly. And the leadership that Jeff and those folks show at that firm is remarkable. But again, now it looks easy, but very difficult. But the only other point I'll make, and it does take some risk or a different way of thinking, you know, in today's market, the 5,000 foot tenants are out there, but you have to do a lot of work for them, a lot of hand-holding. They're mostly not credit tenants. So you have no idea what the fuck you're getting. And it's a different business model than having a broker and sitting and waiting for 30, 40, 50,000 foot tenants. That business is very hard right now. And that's why, to Philippe's point, they're buildings that are just sitting there vacant. We're going and building these spaces for them. We're finding the tenants. We spend 100 meetings walking through. We rebuild them a little bit. Like, it's a very labor-intensive process. But if you want to do the work, those companies are out there. And then there's a further benefit because they do build an ecosystem. You know, if you're trying to create a whole neighborhood, which we are in Williamsburg at Domino, they're very accretive because those people fucking come to work. You run a 5,000 foot office with 14 people in it, those people are at work. Yeah. Especially if you're dealing with new companies or people that are trying to make their way in the world. So it's very good for the energy and the whole environment, but it's a lot of work that a lot of our colleagues are not so keen on.
Yeah. Well, I think you guys should divide up the world. Hudson Yards can just get finance. You get all the creatives.
Yeah.
Dividing line East River, be set. So I wanted to talk about 2 office to resi conversions because they seem to be gaining some steam. And what I'm trying to get a sense of is like, you know, do we expect a dozen more of these projects? Do we expect hundreds more? Sven and Will, maybe you guys can weigh in on that. You've written reports, Sven, and Will, you're selling some of those buildings.
Sure. So, you know, back in 1996, between 96 and 01, we built 13,000 apartments under the 421G program downtown. That sort of, and then that triggered another 17,000 apartment conversions. So, you know, 30,000 apartments. I think that's sort of a good number to have in mind for what we could do in Midtown and maybe additionally in downtown. You know, 30, 40,000 apartments, that's 30, 40 million square feet, give or take. You know, that would make a real dent in the 100 million vacancy that we have. You know, and is that feasible in the next 5 to 10 years? I think it is. You know, we've done, you know, Nate Berman would say, you know, every office building is convertible. Right. The only question is the cost. Yeah. Right? So, you know, now we have, through the New York State housing deal, we have a subsidy program for office conversions that layers in an affordability requirement. We'll see how attractive that is relative to a market rate conversion. We could talk about that if you like.
Yeah, what's your initial sense of that? I mean, they introduced the affordable housing as part of the conversion program. Is market rate still going to pencil out easier than doing that affordable route?
I've done a calculation. It's sort of for a generic Class B office building where the market rate conversion wins out. So, you know, that would be my initial hypothesis, that that's sort of still the most attractive. But I think it varies, building by building, neighborhood by neighborhood.
And Will, what are you seeing? You have some of those, you know, assignments right now for selling buildings that are possible conversions.
Yeah, there's definitely energy behind it. I'd say there's 2 issues. Number one, downtown, because of what went on 25 years ago, a lot of the low-hanging fruit was plucked during that era. All the buildings that were hyperlogical conversions were converted. I think the second thing is that a lot of the things that make something a lousy office building make it a lousy candidate for conversion, which is super deep floors that are incredibly dark, right? And so solving that problem, now Nathan's answer would be, I'll just cut a core, right? Which is where the costs go up and where you need the price to really fall in order to do that. So I think we're going to see a lot of it. I would say the ratio of ink the press spills on this topic versus the reality of what we'll see is still somewhat off kilter. But I think we'll see a lot of it. I think the other thing that we will see finally is almost all of the ones that have been done to date have been as rental. I think you're going to start to see people explore them for condos because there's a gap in the residential market, which is that, you know, 5 years ago, we put a de facto ban on the conversion of apartment buildings to condo. So it used to be that, you know, maybe a couple in their early 30s would have enough money to buy in some white brick building on the Upper East Side that just got converted from rental to condo. We pulled that rug out from under them, and there's never been replacement starter product in the marketplace. So we are starting to hear people say, gee, there's really no non-brand new product available in the market. The brand new product is all priced north of $2,000. I could probably make something worth in the mid to high teens, or better yet, I'll sell the top 3 floors or the top 4 floors as that, buy down my basis, and do the rest as rental. So it's a dynamic market, and we're seeing new underwriting paradigms.
Yeah, that would be an interesting play. And obviously some of these incentives are coming out of the housing bill the housing budget that just went through. Jed, you're head of revenue now. You were right there in the thick of the lobbying when it came to the state budget. Are you happy with where it resulted? We were talking backstage a little bit. I mean, this real estate didn't fall flat on its face. It didn't feel like compared to the last 5 years, but I know not everybody's super happy.
Yeah, I'll be cautious with my words in front of this larger group. Happy? No, I wouldn't say happy. Probably disappointed more than anything. Just from a public policy standpoint, listen, I think there were 4 things we were trying to accomplish. We're trying to generate lots of supply. I do not think that the program that got signed into law will create anywhere near as much supply as New York City needs to solve a housing crisis that was 80 years in the making. Is it better than nothing? Yes, it's better than nothing. But there were tremendous lost opportunities there. We'll see how the numbers come out. It's going to take a while to get data that's really useful. The extension deadline will help over the next couple of years and will kind of distort the numbers a little bit, I would guess. The reality is all of our elected officials, all of them, do not do what it is needed of them that requires some pain to create the amount of housing we need to really impact the market. And until they do, this is going to continue to be a problem.
Yeah.
And they're going to continue to be mad at real estate for making too much money when they create artificial supply-demand dynamics. That was number one. The progress they made that was most disappointing probably was the 2019 rent laws. It's not my business. To create a scenario where it's rational for landlords to warehouse apartments and padlock them because somebody's been living there for 25 years and they need so much work and you can't amortize the work into the rent or make any kind of economic rationale out of it is one of the single dumbest things I've ever experienced in my life. They had a real opportunity to fix it. They don't not understand the problem. Why the politics is such that you're trying to protect, quote, rent in that way is confounding to me. Whoever was there moves out. You have a new renter, and you have a completely rebuilt apartment. It's very warped thinking by my... There were also more creative ways to do it. You could link it up with vouchers. There were a million ways to solve the problem. I found the solution on that somewhere between disappointing and horrifying. Some of the potpourri things we got done. The FAR cap won't show any immediate dividends. Hopefully we can work with the city on some rezonings that'll make that stuff come to fruition. I think it should help conversions over a long period of time. And then good cause eviction kind of is what it is. I think the compromise there was not totally unreasonable.
Yeah.
So that's my takeaway on that. But
do you see
government's ability to impose good public policy on our industry is still very far away from reality, and that's sadly true in the governor's office. It's true at the state legislature, and City Hall was also not as helpful, I have to be honest. I know Eric's coming. I love Eric. He's a dear friend. But in terms of producing housing, nobody really wants to take the medicine to do what it has to do. The City of Yes thing actually has more stuff in it that will help on the margins than at first appears. So kudos to Dan Garodnick on that. Now I'll shut up before I get myself in lots of trouble.
And do you think it's a matter of, the electeds not being educated, or it's just a political calculus? Sam Charney's doing an interesting thing where he's going around, he's going to be on a panel later today, where he's going around to electeds and giving them this really simple program and saying there's a drop down for, floor area ratio, a drop down for affordability. Like, here's how the numbers pencil out. Like, you have to live in reality.
I think it's a combination of things. I think none of them are housing experts. Fair. But our business is really dumb, okay? I have a little boy who's in the 7th grade. He knows enough math to run my business. It's not a complicated business. So on the one hand, they're not housing policy geniuses. On the other hand, I don't totally let them slide because the math is very straightforward. I think the answer is really both politics and perception. I think real estate's a long-term business. The amount of housing you'd have to create to really decrease rents will take a generation or two. Politicians have to get elected every 2 or 4 years. They don't do anything with that kind of timeline. And probably, in fairness, in the short term, when you only build a little bit of housing, we're the beneficiaries and rents don't go down. So you're stuck in a vortex where unless you really commit to a long-term, decades-long program, they're not going to see the political benefits that they want. That's number one. And number two, there's a trust factor because of the growth of New York City over the last 25 years, because of historically low interest rates, because we work in a business with tremendous amounts of capital and tremendous amounts of leverage, and because government has created a cartel out of our business over the last 100 years, you intersect those things and you've got too many billionaires in our business. And it becomes very easy to not comprehend the difference between a handful of people that have made too much money and bad policy. And they conflate, oh, Jed makes too much money, and Jeff and Steven make too much money, and therefore the housing policy's fucked up and too rich. And while that's an easy mistake to make, that's wrong.
Yeah.
Right? So then you've got a very complicated politics, and you get really stupid people saying, oh, the tax breaks are a giveaway to them. Like, no. When we don't build anything, there are no taxes. So that conversation's been like wildly distorted, but we've created an easy paradigm for people who want to distort that to distort it.
Yeah, that's why I think it's interesting you're head of revenue now, because I think the trade groups were, a little antiquated and behind the time, and social media and all the, effective tools of getting the message out. Like, are there ways you're thinking about modernizing revenue or, digital pushes that might not occur to octogenarian chairman of revenue, right?
Yeah, listen, my predecessors did a wonderful job as chairman. I'll bring a different style. The world changes every day. I think we need to react to that. Yes, there's work we can do on perception. There's work we can do on education. And there are other models for it. Listen, California is a very blue state. Over the last 10 years, they've made real progress on their housing policy stuff, okay? They've organized it differently than we have, right? There are lessons to learn from folks, and some things just take a lot of time. And fixing this is going to take time. It's going to be very incremental. There's not a silver bullet answer.
Yeah, well, I think what YIMBY is doing is kind of interesting. That's a fresh take coming out of California and
it's
some
helpful.
Of that stuff. Yeah. Well, the other thing is, New York needs a continual stream of big ideas and big plans, and one that, Related is working on now is this $12 billion casino plan, finishing Hudson Yards. And Philippe, I wanted to ask you about that. You got the casino, you got 2 million square feet of offices. How does that all kind of hang together?
Well, I think probably one of the most important things in terms of hanging together is we get to cover a 14-acre rail yard, right, which is open track right now, right, and it's not a productive use of anything in New York. So that's number one. Number two is we get to put another 6 acres of parks that basically, it was always part of the planning basically for Hudson Boulevard and the High Line and the West Street and the Hudson River Park was to basically converge on one place, right? And that was the park in the middle of the Western Rail Yards, right? So we've created this amazing park that's going to come along with it. And in terms of the mix of uses, I think it's fair to say that there's never going to be a gaming or resort quite like this. It's going to be the highest end that there is, consistent with Hudson Yards. We've been speaking with all of our tenants, so they know the facts and they know what's up, and people are excited. And a big part of that is because what comes with building out the Western Yards in that sense and bringing a big resort is 1,500 more hotel rooms, over 15 high-end restaurants, actually, I guess at different price points, right? More ground floor retail, right? More energy. Talked about the park. So there's a lot of benefits that come along with it, and we're excited to kind of finish out the plan. And there's also, as part of it, like you said, a 2.5 million square foot office building that we're actually having conversations with anchor tenants right now because it's a special opportunity for someone.
Yeah, and of course there's some people that don't like a casino, but you know, you don't want it to be Atlantic City, you want it to be Foxwoods, right? I mean, is there a model for what you have in mind of how to keep it?
I think Wynn is the best operator by far, right? They are the highest end operator if you've ever been to Vegas. But we're going to combine it with kind of what we bring from a design standpoint. So I think, there's nothing like this out there that's going to be created, and we think it's the best location because it's an opportunity to tap into the Javits Center, 7 train, transit, right? Everything that's going on around there to create sort of a high energy district, which I think if you look from an economic development standpoint, right, at the places that have been most successful with resort hotels and gaming, they're plugged into a whole ecosystem like that.
So that's kind of the development end of things. Will, do you think there's going to be a lot of building trades ahead in the next year? We have Howard Lutnick coming on later. He thinks it's going to be just this massive, massive transfer of wealth in the next year or two as far as building sales. Is that what you're envisioning as well?
Well, sadly, transfer of wealth might not be the phrase, but there's definitely an uptick in activity. I think you have people on good office basically calling a bottom. You have people who are rationalizing the idea of selling because they're saying, if we are indeed higher for longer, what am I waiting for? I can take my money and try to redeploy it in something more successful elsewhere. So I think we're going to have a lot of liquidity in the marketplace, and we're also going to have willing sellers in the market. So I would agree. I foresee a tremendous amount of activity, and we're already starting to see it.
Yeah. Well, my last question, I want to circle back to Mayor Suarez. And Philippe, you've got a project down in Brickell that, you know, there's 3 or 4 competing towers in Brickell. None have had pre-leases yet. It's, you know, it's getting to be a more competitive environment down there. Would you rather be doing a project in New York or South Florida today for office if you had to choose one or the other?
I always have to be careful.
You can't choose both.
We're bullish on both. You look, and we always knew this going in Brickell and Miami, it's not a pre-let market. During COVID, there was a sea change in terms of looking at South Florida. I think what Stephen Related had done at West Palm Beach has been nothing short of extraordinary in terms of creating a community there. And we're big believers in Miami, but and we've always been convinced if we had a building up now, it'd be at least half leased. There's no good product. There's a lot of schlock developers.
Yeah.
People want to be down there, but it's really not it's not 100,000 square foot plus market. So the whole challenge is, how do you get going? I mean, look, when you look at markets across the country, I was doing a lot more flying, 2-3 years ago than I am now. We have a lot of activity in New York, and I think New York's really the strongest commercial market in the country. We have a lot of issues. We have things to work through, but in terms of, if you talk to any top companies, they are growing. They are saying that New York is second to none in terms of our labor pool and talent, and that goes across every industry, including technology, right? Where we have tech companies that tell us, and look, tech, as Jed had said, tech had taken a ton of space, right? So it doesn't take a genius to expect, like, at some point the party is going to be over.
Yeah.
that's gonna shrink. But who knew 15 years ago that if we'd made a pronouncement that New York was going to be like basically number 2 market in the country for technology, we would have been laughed out of the room. And I would say it's number 2, and probably if you ask a lot of tech companies, it's actually number 1.
Yeah.
Right. So I think huge positive momentum for New York in that case.
It seems like things are moving in the right direction, and obviously you guys are putting your money where your mouth is by building all this space. So I want to thank all these guys. Good to have them on the panel, and we've got another one coming up soon. Thanks, everybody.